Okay. And what can China do to sort of do they have to devalue? Can they sort of hold the line?
Well, I think the situation. I mean, the first thing to say is, look, China is in a very difficult situation because through the period of, I mean, it's maybe one draws the parallel. This is exactly what went on. If you draw the parallel with Japan in the 1980s and then 90s, or the emerging Asian economies in the 1990s or early 1990s and then late 1990s. And what you see initially are huge capital inflows going into an economy, and that was something that occurred in the case of Japan. It occurred in emerging Asia. It occurred in China. That caused the real exchange rate to go up. And if those countries did not want their nominal currencies to rise, then they basically stabilized those currencies, but they let their price levels, and particularly their asset price levels, surge. And you saw that in the case of all three economies. So China had an asset boom. As capital leaves those economies on the other side of that boom, you get capital exodus, then you get the real exchange rate going down. Now, that either means you let your nominal currency collapse, or what you do is you let your asset markets deflate. And that is what those three economies faced and what China is facing now. So, what you're looking at is a lot of downward pressure on the Chinese yuan or the Chinese real exchange rate. And either they let their asset markets continue to deflate, which is that must have limits, because you destroy your credit system if you keep allowing asset prices to go down, or you devalue your nominal exchange rate. And that's exactly what China is basically doing now. Now, my expectation always was that the Chinese yuan would basically hit 8 to the US dollar. It's currently about 7.3, but it has devalued significantly in the last 6 months, when it was in the high sixes. So you've already had a appreciable depreciation or significant depreciation. What you're beginning to see now in the capital flow data are signs that capital flows are beginning to return to China. Now, if this trend continues, then you may start to get some stabilization in the Chinese yuan real exchange rate, which means there is a degree of freedom there for the Chinese to actually ease monetary policy while maintaining more stability in the yuan. And that backdrop will be extremely positive for Chinese asset markets.
It's interesting because it seems like a similar theme that you mentioned potentially will happen to Western countries in the coming years as well, with sort of their increasing deficits because of their increasing liabilities.
Well, I
Is
think in
there?
terms of I think that's a slightly different. That's deficits on the government accounts, right? And here we're talking about, we're talking about shortfalls of capital flow. But deficits are deficits, and deficits need to be funded, and that is really what this all comes back to. So I think what you've got is a situation whereby there are a lot of challenges out there. The easiest way to understand the world is through capital flow or flow of funds, and this is what it's all about. Capital flows drive economies. Economies don't drive capital flows, and that's the fact that is making the world very difficult for textbook economics to understand. What we've got is a shift in the polarity of money flows worldwide over the last 20 years, and that's why a lot of these economic models no longer work. And that's why we come back to the fact you've got to understand liquidity and flow of funds, because that's really that's what has been guiding many of our predictions, and it has become an oracle in many ways in understanding economic developments.